we step into the new year and try to put what has undoubtedly been the worst year in living memory behind us, we at TT Now are delighted to bring our viewers an interaction with Dr. Raghuram Rajan, former Governor, Reserve Bank of India, presently Professor of Finance at the University of Chicago, Booth School of Business. Prior to taking over as RBI Governor, Dr. Rajan served as Chief Economic Advisor, Government of India, and also Chief Economist, International Monetary Fund, the youngest to be appointed to the post. So it goes without saying that he brings to the table a unique blend of domestic and international experience in both the fiscal and the monetary policy space. Welcome to the show, Dr. Rajan.
Thanks for having me.
Well, I'd planned to start this interview with the obvious opening question, your assessment of the macroeconomy. But on a day when the Sensex came tantalizingly close to the hitherto unimaginable 50,000 mark, it was just 26,000 odd on the 23rd of March 2020. The macroeconomy must take a backseat to the question that's uppermost in the minds of almost all our viewers. What explains the disconnect between markets and the real economy? And I think I speak for all of them when I say, can you please do some crystal gazing for us? It is said that the seeds of the next bust are laid in the previous boom. But this is not an across-the-board boom. Economies are still struggling. So as someone who was amazingly prescient about the 2008 crisis, what is your take? Are we in for a rude shock, Raghu?
Well, it's very hard to say, right? I think one has to look around the world, and Bitcoin reached 40,000 after being 10,000, in the beginning of last year. So Bitcoin is the classic bubble, right? It produces no value. It is an asset which can't even be used for payment because it is really difficult. As my friend Austin Goolsbee says, they don't take Bitcoin as payment in the Bitcoin conference because it's just too costly. And yet it hit $40,000. So why are people buying Bitcoin? Because they think it'll go up. Well, that's very bubblish in thinking. Tesla, another case where it's being priced at many multiples of the price of solid car companies like Toyota or General Motors, and you have to have a very firm view of their success and the spread of the vehicles they're making to justify the kinds of prices that are being paid. So it's not as if everything is priced in a way we understand. Now, that doesn't immediately imply that the bust is coming. There are certainly, when people talk about it, reasons to believe that there are underlying supports. The very easy monetary policy, the very low interest rates, the fact that economies are in rebound. I call it a rebound, as Carmen Reinhardt calls it, rather than a recovery, because a recovery means you go back to the place you were. We're still way below the place we were, but we are recovering. We are rebounding quite fast. And especially in manufacturing, that rebound is showing up in good results relative to the previous year. And it's suggestive that nothing really happened to impede growth. The truth is somewhat different. But and of course, there are lots of small investors with plenty of money, sometimes from transfers, sometimes from sitting at home and not spending it elsewhere, who are also punting on the stock market. So low interest rates, the fact that manufacturing is back and sometimes is showing healthy growth, the fact that many large companies are benefiting while small companies are going out of business, all that creates a temporary positive sense about where the economy is going. Of course, a lot of damage has been done, and this will show up in the medium term. And the question is are the positives enough to offset the negatives? And I don't want to be a stock market expert and tell you it's going to go up by this much and so on. I don't know. But I do think that it's a good time to be diversified.
Okay, so you do see a disconnect, and you did use the word temporary.
Well, certainly in terms of demand and in terms of results, it seems to me that what happens is, certainly in India, there is pent-up demand from the rich. I mean, look at the divergence between auto sales, which are growing year on year, while two-wheeler sales are not. they cater to two different communities, two different groups. The upper middle class are the auto sales, the lower middle class and poorer people are the two-wheelers. And that's suggesting, as is true of certainly industrial countries, that this is a two-speed process. The rich are, in part, because their wealth is also tied to things like the census, they're doing pretty well, and the not so well off are not. And the question is, can we completely ignore that segment? Certainly we can't politically, but even economically, I think it's quite important to think about how their consumption comes back. 18 million jobs by some counts have been lost in India still. And what about their purchasing power? Does that not make a difference?
If I can just interrupt, Raghu, you don't see this purely as a liquidity-driven?
Yeah, no, that's what I meant by central banks in the action. What is being priced is not just the numerator. And as I said, in manufacturing, that numerator, and in tech, where it never went down, that numerator is quite high. But the discount rate at which that is being discounted is also very low because we have very low interest rates. You put those two together, you can get a high price. The question is, one, how long the high earnings will remain if the rest of the economy is more troubled after the initial bout of strong demand? Is the rest of the economy going to express itself in some way? And the second question is, are those rates going to stay low forever, which is what the markets seem to be pricing? So the temporary low performance is being ignored in favor of we're going to get a strong rebound, and then things are going to look good going forward. That's what we're pricing. And at low interest rates, the near term doesn't matter relative to the long term. So I think all those are the calculations the market is making. There is, of course, also the froth that small investors induce into the markets. And this is where, the things like Bitcoin, things like Tesla get priced up because people are just jumping in. And I presume there are similar stocks in India where, the punters basically think they can make quick money and get out. And so things get driven up. Now, at some point, and this is the growing worry in the United States that inflation, even if not permanently high, given the post global financial crisis experience, is going to start showing up a little more.
Yes.
And then the question is, how long will central banks remain on hold if inflation perks up more strongly? The Fed has said it's going to look through initial bouts of inflation and look to what might be permanently higher. But everybody is asking, how long will the Fed stay on hold? Right now, the Fed has said it's not even thinking about raising interest rates. So that's a pretty strong argument to believe it will be quite some time before the Fed raises rates. And I think that's a fair point. But markets, of course, react before the central banks will react. And you already see the 10-year bond, the rates have moved up over the last few weeks.
Absolutely. Now let me just come down to the earth a little bit more and ask you, how do you see the macroeconomic scenario globally? We'll come to India a little later, but very briefly, globally.
The vaccine, the advent of the vaccines certainly put a time stamp on when we hope the pandemic will be fully contained. Of course, there is some uncertainty about the rollout of the vaccine, but the sense is by the third quarter of next year, most of the population in industrial countries will be vaccinated. And therefore, the high contact services, hospitality, restaurants, they will be back in business at that point. What is a big uncertainty, actually two sources of uncertainty. One is the second wave, which is more virulent, which is causing countries to reach new highs in terms of cases. when that will be contained and what drastic measures will be needed. The UK just implemented very significant drastic measures to contain the spread of the second wave. And that is going to impinge severely on economic activity in the first quarter of this year. Does it have to be longer? That's the big uncertainty. And so between now and the third quarter, what is the level of economic activity? So far, it still is impinging on high contact services, not so much on manufacturing, where companies have figured out how to do social distancing and so on. But there is, services are certainly the biggest part of economic activity here. Highly skilled services seem to be continuing. People are doing business, finance, consulting all over the online. But the low-skilled, high-contact services are still in abeyance. So that's about 10-20% of the economy, which will be severely affected if these lockdowns continue. The other big question is the mutation of the virus, right? The second wave is being caused by, certainly in the UK, by a mutation. And the question is, are our vaccines capable of handling further mutations? So far, the answer seems to be yes, but that's not complete. That is the tail risk that we don't contain the virus fully. But put together, the markets are pricing a strong recovery, certainly from the second quarter of this year. And that is part of the reason for the exuberance in the markets. That exuberance is carrying across all assets, which is partly why India is seeing it, because once you've priced up the S&P 500 and you've gone to value from growth stocks, then you look for emerging market stocks, you look for high yield bonds. Every asset is being priced up. Part of the reason that Bitcoin is also in the stratosphere. So India is not unique in this. Every emerging market is experiencing a repricing. And the question is, of course, which we started with, how much is this justified given economic conditions?
Oh, absolutely. It's a big billion-dollar question. But do you see the US turn more outward or at least less inward under the Biden presidency? Is the US-China trade war history? Can we expect a reversal of the protectionist tendencies and a revival of global trade?
It's not history. I think the mistake to make is that the Biden administration will turn over and be very, very friendly to the Chinese administration. The difficulties between the two countries are much deeper. There is a tremendous amount of suspicion in Washington of the Xi Jinping administration in China. Past promises not to militarize the South China Sea have been violated. The China, vision going forward, in contrast to Russia, which was a Cold War opponent of the US, but never a serious economic power, China is both a serious economic power as also a military power and is doing a lot of work in the areas of dual-use technology, right? In artificial intelligence, in chips, in cyber security, etc. And so the US is very worried that Chinese progress in these areas will also make it much more of a military threat. And so the Biden administration is not going to turn around and bend over backwards to remove the tariffs. What it's going to do is have a more reasoned negotiation. I think that you can expect from the Biden administration. It's also trying to bring together its allies, Japan, Europe, in that negotiation so that it becomes a more across-the-board negotiation with China. Look, we want you to succeed, but we don't want you to violate the terms of engagement. So it is going to be discussions about intellectual property. It's going to be discussions about standards. I think the tariffs will not be withdrawn on day one. They will be held, even though the tariffs largely hurt the US and the US consumers paying for it. I think withdrawing them from day one will look bad. They will be held as a negotiating tool. And over time, quite possibly they may be withdrawn, but I don't see it being an overnight thing.
Okay, so not very good news for global trade. But let me now turn to India. Do you believe, as some people like noted journalist Swaminathan Iyer do, that we're experiencing a V-shaped recovery? Or do you believe, as I do, that it's much too early to say, because after the 24% contraction in GDP that we saw in the first quarter, almost anything will look good by comparison. How would you assess the health of the Indian economy?
Well, all our numbers typically come from the formal sector of the economy and from large firms. Now, the Statistics Organization did try and extrapolate a little bit to the informal sector, but we don't know how effective that is. And really, as we discussed earlier, this pandemic has much greater effect on the informal sector, the small and medium enterprises, the ones that don't have deep resources. And the question is, how much has both the lockdown as well as the social distancing measures after that affected these enterprises? Certainly, when you look at formal employment, it's down significantly. But informal employment is probably down much more, and guesstimates are, maybe 18 million people are unemployed right now relative to what they were before the pandemic hit. So I think I'm in your camp that we will see a strong wave of growth. I mean, any country has to grow after being down, 25% of GDP. We will see a rebound. The question is, what are we doing to make up the lost ground? The World Bank estimates we will have lost $900 billion of GDP by the time this is over. Now, I don't know how good those estimates are, but that is 1/3 of GDP. How long will it take to reach the track we were on before the pandemic? Now, for the US, people say sometime in the second quarter of this year, we will be back. For India, my guess is we probably will not be back till late next year, 2022, to where we might have been, before the pandemic. And of course, then to make up the ground that we lost, because we were growing at 4-5% before then. So that's a line which is going up, and we need to go back to that line. It will take a little longer. So my sense is we go back to status quo ante sometime, late this year or early next year, and then we make up further lost ground over the course. But we certainly have lost a lot of ground during this process. Now, how this affects demand, how this affects the longer-term health of the economy, I think you're absolutely right, too early to tell. I also worry about the structural damage done. Damage done to households, damage done to children who, now have been taken out of school for a long time, or who haven't been able to keep up with their classes. And we need to prepare for all that. What kind of remedial systems do we have when a kid which has been out of school for a year goes back to school? I mean, not only have they not learned over this year, but they've forgotten a lot. How do we bring them back up to speed? Or do we risk a permanent loss in learning in the next generation? Those are things we need to start preparing for. I think looking at the Sensex, one thinks problems are over. No, they're just starting.
Absolutely not, I agree. But after the global financial crisis in 2008, RBI was quick to respond and ease liquidity. But now, with the wisdom of hindsight, many of the problems of the later years, including high non-performing assets, are being attributed to the excessively loose monetary and fiscal policy in the aftermath of the crisis. This time round as well, the RBI has responded by easing liquidity. But as you watch the evolving situation, large excess liquidity, inflation rising, though the latest numbers showed some moderation, asset bubbles, stock market, commodity markets, is there a sense that maybe, just maybe, the lessons of 2008 have not been fully learned?
Yeah. I think the lessons of 2008 are that it's not just stimulus which is needed to repair the system. We need to look to our fundamental processes and make them better. so that that's what drives the economy going after that, rather than easy money or fiscal spending, right? So that's what we need to do at this point. I keep saying that we are missing the need to repair. There is a lot of repair and relief that is needed in the economy, and we focus too much on stimulus, when in fact there are parts of the economy which are hurting deeply and need support. But beyond the repair, of course, there is the issue of reforms to make the growth sustainable. And clearly, the government has been attempting some reforms. One can go into the details of why some of them have become controversial. But the reality is that we need a lot, because our growth rate was falling even before the pandemic. And we need to ensure that we have a much higher growth rate, not just to recover the ground we have lost, but also to create jobs for those many millions who are joining the labor force.
One of the reasons why RBI has maintained this excessively easy liquidity stance is that it fears that a premature withdrawal of liquidity will hurt growth. Yes, this is possible, but timing of withdrawal is always difficult and fraught with risks. So how should central banks walk this tightrope of exiting the easy money policy without jeopardizing either financial stability or growth? How did you, for instance, deal with a very similar situation when you were governor in 2013?
Yeah, no, this is a difficult situation that central banks have gotten into. Let me talk about the Fed, because I don't want to talk directly about RBI policy. The Fed has essentially opened the floodgates on not just liquidity, but credit. It is lending to entities it has never lent before, including private sector entities, right? And of course, there is a real question of what happens when it sort of takes off the support. And to some extent, the Treasury has forced the Fed's hand by essentially saying, you can't continue these programs beyond, I think it was January 1st. And as a result, the support was withdrawn. But the market has a momentum of its own. And part of it is being driven, in my view, by the knowledge that if the Fed came in once, it can come in again. And therefore, the market has the Fed's backing. And this is the problem with any central bank action. Once you take the action, the markets take it as given that you will act again if need be. And that becomes an implicit source of support. And the problem the Fed then has is that even if it backs off, market calculations are always made saying that, if things drop, the Fed will come in once again. And that is a very distorted way of pricing the entire structure. So I think the RBI will have certainly the task of withdrawing these measures. It started on that process, but it not only has to withdraw the actual measures, but over time withdraw the sense that it's always there to support the markets. Now, the good news is the RBI has been more circumspect than other central banks, and therefore there's less to do about it. But it is a question that the RBI will have to confront over time.
I think countries like India don't have the luxury of advanced countries, that is true. But in the Indian context, how would you gauge the success of the inflation targeting regime? Yes, inflation came down dramatically pre-COVID, but if we accept that growth had also begun to slow down pre-COVID, which is something that you also mentioned, is it safe to say that perhaps we paid a price in terms of the growth foregone by adhering too rigidly to an inflation target? And in the light of our experience and the rethink on inflation targeting worldwide, is there a case for a wider band? Should we rework the framework, or should we rework only the band?
We in India tend to be very, very I think two-faced about institutions. On the one hand, we want to improve the institutions. On the other hand, we resent any potential constraints they place on us. My personal view is the inflation targeting regime was a good signaling device for India to say that we are concerned about inflation, we will not let it get out of control, and has been very useful during this period of turmoil, because even though inflation was surprisingly high for a variety of reasons, our bond yields still stayed relatively low, with the sense that the RBI would focus on bringing inflation down to the band that it had set for itself. And in fact, what we see with the latest reading is it's back within the band. So I think the point here is those institutions are somewhat constraining sometimes, but also are very important in helping us convince the broader investing public as well as markets that we aim to have the right policies. Now, one could also dispute the fact that this has been very detrimental for growth, in the sense that, even though rates, were cut, the constraint on lending has not been the level of interest rates, which have been really low in real terms. When you subtract inflation, they've been globally very low. So you can't hold the RBI, certainly at this point, as responsible for having high interest rates. But really, the problem has been the bad loans in the sector, the banking system itself, which is reluctant to lend for a variety of reasons. And so credit growth has been very slow. And that is not a problem of monetary policy. It's a problem of fixing the banking system, cleaning it up to ensure that it has the willingness to lend, but also reducing the risks in lending, which is a very government-centric task. How do you make sure that, for example, for infrastructure projects, land can be acquired reasonably easily so that projects can get on track? There's no point, at this point, banks are very reluctant to lend to infrastructure projects because there's no sense of when you will acquire the land. Take the government's flagship project, the Mumbai-Ahmedabad Railroad. I mean, that's been stuck for land acquisition reasons. So all the prestige of the government put into this, all the political power of this very strong government put into it, it still doesn't manage to do it. That means there's a problem that needs to be fixed.
Oh, absolutely. Lots of problems, particularly a democracy like ours. But with budget 21-22 around the corner, let me now shift to the budget. Budget arithmetic for 2021 has obviously gone for a toss. So how should the government approach budget 21-22? Should it try and cut spending, or is that the worst thing to do when capital formation is falling and the economy is slated to contract 7.7% this year? And technically we're in a recession. How should government prioritize its spending? Like the classic butter versus guns choice in Economics 101, does the choice really boil down to healthcare versus roads, defense expenditure? How does the government go about its budget?
I think the word prioritization is obviously very important. It has to prioritize spending, which means focus on what is essential. And I would start with relief to the poorer households and ensure that there is adequate relief to the small and medium enterprises. But then move on to how do you get the economy back on track? And clearly, one of the best ways the government has of getting the economy back on track is, doing the spending on infrastructure, much of which is done by state governments rather than central governments. So getting the money out to the states is quite important. This is the wrong time to starve the states. But making that kind of push, ensuring that the government has paid all its bills so that the liquidity goes back to companies who can use that for investment. Those are all aspects of what the government needs to do. So where does it cut? Well, it has to find places to cut. Typically, it starts with, okay, we're not going to use as much paper in the printers. Those are low ticket items. You have to find out, bigger places you can cut. But the greater sort of source of reducing the deficit may be in selling assets. And one of the things the government promises every time and defaults on is, selling government companies. They call it privatization. Nothing really has been privatized. What you've done is share sales. But even that, I mean, look, you just started this program saying the census was hitting 50,000. Where are the share sales? You should be selling shares, from every rooftop if you are in a tight constraint. Why aren't we doing that? What is it that is holding back? My guess is we made some progress, but I would want to take advantage of high prices. If I could, I should have had these on tap to sell. But so more infrastructure financed by share sales and so on, and getting the infrastructure spending out through the states may be easier than getting it all done by the center. Those are things to consider as we go forward. Clearly, reforms are important, but we have to do them in a way that doesn't prompt a reaction, which means much more thought going into them, much more consultation, and much less of a my way or the highway.
Absolutely. In fact, it's a constant puzzle why private companies have been able to raise very much more than what the government's own disinvestment target has been for this year. But an idea that keeps doing the rounds is really that of a bad bank. You spoke about banks, credit offtake being very slow, banks not being willing to lend. So should the budget set aside funds for a bad bank, or is recapitalization of existing banks a better idea? Also, since recap banks are only really a book entry with limited implications for fiscal deficit, even though they might increase the debt to GDP ratio, what explains the government's reluctance, to your mind, to go in for recap bonds?
Well, I would think that there are reasonable concerns in a government on sort of filling a leaky bucket. The real problem with our public sector banks is they need to be filled every few years because they make yet another set of bad loans, which require the capital to be replenished. And so without governance reform, I think the reluctance to fill that bucket is understandable. But that means that much more work has to be done on governance. How do you rectify the governance of our public sector banks? Some people would say there is no alternative to privatization, but it's not clear to me that privatizing and having some big entity sort of take over and mismanage the process is necessarily a good thing either. So what you want is to strengthen the governance and then maybe sell the shares more publicly so it becomes a publicly owned company and can then depart from the strictures that the government ownership imposed on it. But for that, you have to strengthen governance. And that can be done even under the government. There was a plan put in place with the Bank Board Bureau and the selection of professionals as directors, etc. That went off track. You need to revisit it and find out, what went wrong. How do we improve the governance of these public sector banks? How do we get professional directors? How do we get the board to be responsible? How do we get it to appoint the CEO? How can we use some of the talent that's available in the private sector to manage these banks? And make them entities that are really capable of handling the enormous amounts of money that the public entrusts them with. And if that is the case, then recapitalization becomes much more sensible. So I would, of course, we can't wait till that process eventually happens, but it has to be a parallel process. And again, I worry that we're wasting time doing nothing, having these huge debates. Now, Viral Acharya and I proposed a bad bank. I was very much against the idea in the past because it was just transferring money from one pocket of the government to the other pocket. How would the bad bank do anything differently from the public sector banks that already own the loans? I can see one reason for a bad bank to aggregate loans, which is it may be more effective in restructuring, handling those loans because it doesn't need the permission of the 18 banks who held the loans earlier. It aggregates those loans. But in order for that to work, the bad bank has to have the personnel who have the competence and the capability of negotiating with the private sector entrepreneur, the promoter, and ensuring that the banks get a fair deal. That today, that capability does not exist in the system. And the question is, how do we create that capability? How do we create a bad bank with that that ability. But also the bad bank has to be quite transparent on the prices it pays the public sector banks when it buys the loans from them. It should probably also be willing to buy from the private sector banks. This is a different entity from the ones we've had in the past, and it cannot be governed by CBI, CIC, CAG, because that will ensure it does exactly the same thing as the public sector banks, which unfortunately today is too little. So that means an entity which is differently structured, has more, looks more like a joint venture or a PPP rather than a public sector entity.
So do governance failures, especially at public sector banks, explain the high level of NPAs and the inability to get them down, even though we tried so many things, including the insolvency and bankruptcy code? So what is your assessment? Because the numbers that the latest FSR gives is about close to 15% in a severe stress scenario. And this is likely to be an underestimate in view of the regulatory forbearances currently in force. So is it entirely governance problems?
No, I think we made progress. We had brought them down after the AQR, the asset quality review conducted by the RBI in 2015, the recognition that there were significant amounts of bad loans, and then the attempt to bring them down. We had brought them down. Of course, in the middle, we had the demonetization program, which set the banks off on an entirely different course for some time. We had the slowing growth, which would also raise NPAs. But despite that, the banks had managed to bring them down. And then we have the jatka of the pandemic, which clearly creates more problems in the small and medium enterprises, where we had a huge sort of push with the Mudra scheme that the government put in place. And so those loans, many of them are in trouble. So, it's not the same old problem. The problem keeps shifting. But I think the general message is we need to focus on cleaning up, which is why I'm a little surprised that we've put the bankruptcy code in abeyance, because there's so much more need for it to function now to deal with all the sort of building problems. And what we have to do is just follow through on many of the schemes that we had in mind. Again, on governance, we've been talking for a long time about governance, and the Bank Board Bureau was set up purely for this. But, for a variety of reasons, it was not allowed to function. And as a result, we haven't had the governance changes that we desperately require. So think through this and start implementing and follow through. Following through is our big problem. You talked about, we implemented inflation targeting before we've even gotten full credibility and benefit from it. We're thinking of changing it. I mean, come on, follow through and finish the task, implement successfully, keep making changes if need be at the margin, but don't throw out the whole process and say, okay, let's try something else. That ensures that you never get anywhere.
Quite possibly, but I think COVID has really kind of put a spoke in everybody's wheels. But let me now move to NBFCs. Banks and NBFCs, non-bank finance companies, are distinctly different animals. NBFCs are not part of the payment system. They cannot take deposits which are repayable on demand. They cannot issue checks, etc. However, because the growing interlinkages between banks and NBFCs and fear of systemic implications of the collapse of a large NBFC, we saw it happen with ILFS, are we veering towards a situation where we try to protect NBFCs from failure? How important is it to ensure that the lines between banks and NBFCs and other financial sector players like mutual funds are not blurred to the extent that the rescue of shadow banks is equated with the rescue of banks?
Yeah, unfortunately, everything in India ends up on bank balance sheets, because banks are so central to the system. I mean, look at who's buying NBFC debt. Often it's the banks that are lending to the NBFCs, even though NBFCs are meant to be different risk pools. NBFCs lend a lot more to real estate than banks are allowed to. But of course, banks have lent to the NBFCs, and the whole thing becomes sort of enmeshed. So certainly the RBI has been thinking about the interconnections and the possibility of contagion from areas that the banks are not supposed to be in, but are in indirectly because they have assets, they have the debt of those entities. So going forward, I think, reducing some of these interactions by imposing the kind of limitations on bank holdings of different kinds of assets. For example, bank holdings exposure to specific groups, corporate groups. There is a regulation in place which requires them not to have a certain more than a certain amount of capital. But we have put that in abeyance for a little while, given the problems of the pandemic. We should bring that back strongly and ensure no single entity in the system is big in bank balance sheets. Similarly, for NBFCs, we need to make sure that banks don't have a big exposure to the NBFCs. This is a process, can't be done overnight, but has to be done in a regular fashion. That will then ensure NBFCs are a different risk pool from the banks, and they can be allowed to fail, and therefore they can merit perhaps less monitoring, less supervision than the banks themselves. But you can't actually have them so tightly connected and at the same time say they can take greater risk, but we're not going to monitor them so closely, because then, as you said, you run the risk of them becoming too big to fail and you intervene every time.
Raghu, you spoke about the need for structural reforms, but is the government caught between a rock and a hard place? Because when it acts on that advice and it goes in for such reforms, for example, enacts much needed farm laws, then you have a backlash from interests that get hurt in the process and which have enjoyed the spoils for a very long time. So what is the way forward in a democracy where the right to protest is also very much a right, as is the right to need structural reform?
I think that means that it has to be much more clever about how it does these things. It has enormous political sort of power, but it can't use it without consultation, without talking to the people who will be affected. And oftentimes being clever means not doing it itself, but working through the states. There is a sense in which the reforms that are being done are essentially not taking the entire set of possibilities into account. And because they're so centralized, because they're thought through by a small group of people, yes, we've been debating this for a long time. But when it comes to implementing them, you have to think about the reality of India. For example, not every state uses the mandi as much as Punjab and Haryana. Does that not mean we have different sets of reforms for those? What may have been better, in hindsight, of course, is a more enabling structure which allows states to move forward. Now, of course, the center can say the states aren't moving. Well, that means bring them together on this process. Bring the other political parties so that they cannot make hay on this reform process. But that requires consultation. That requires a much more democratic approach than the government has followed. So and that is why it is quite important for the government to change its ways.
Okay, much more dialogue. But I know you have to leave, Raghu, very soon. So this will be our last question. What would your advice be to Government of India if you were the Chief Economic Advisor? Or if you were RBI Governor? I know you would say this is a hypothetical question, but our viewers would be very keen to hear your views. So please don't disappoint them. So what would you tell government if you were Chief Economic Advisor? What if you were RBI Governor?
Well, I'm neither of those, and I don't want to preempt what my successors have in mind. They're all very capable people. As an economist, let me wear that hat. Talking from the outside, I do think that it's important to not get taken, to get confused by the stock market or by the sort of performance of our large companies, which undoubtedly is refreshing. But to recognize there has, if the US, after spending 25% of GDP, still thinks there has been substantial damage done to the economy, clearly there's damage done to the Indian economy. And to recognize that this damage needs to be addressed over the medium term, if we are to get anywhere back to the levels of growth that we are capable of. And that requires both relief, repair, as well as a focus on reforms. And I can understand some in the government being dejected by this process, but I think this pushback against its farm laws, for example. But I think that's a time for reflection to understand why this is not working as advertised, why people aren't embracing reforms with open arms, and then change the process by which it's done to something which is more inclusive and has a greater chance of succeeding.
And can I also add, don't obsess excessively about the fiscal deficit?
Look, I think it's important to keep an eye on it, which means that we cannot spend as if there's no tomorrow. That's unfortunately a luxury we don't have. Maybe the US has, but maybe even the US doesn't have it. But I do think that there is room for spending if it means strengthening the economy over the medium term. And that includes a lot of morally justified spending on our poor households to make sure that they can survive well into the future. So I would say that, if you can explain why you're spending, and you can be more transparent about the whole process, not hide, spending here and hide debt there, but be transparent and say, we will get back on track. And here are commitments to get us back on track. You can actually expand the envelope and then focus on the spending that is absolutely necessary to get us back. So I would say this requires a change once again in the government's approach. Don't treat it as something that is only necessary. You have smoke and mirrors to convince the markets. Be clean and say, this is necessary to get us back on track, and we will do it. We don't care what you think, but we do want your respect. And therefore, over the medium term, we will come back to fiscal responsibility. In the short run, the economy needs this kind of spending. I think that kind of message can fly. But, we also have a lot of assets. Sell those assets while we are spending more.
I know I said that was going to be my last question, but I cannot resist asking you just one more. When you look back at your journey, the transition from academia to policy making and then back to academia, what would you choose if you were given a choice? The sane and calm world of academia or the hurly-burly of policy making?
Well, each one has its charms at the right time. So I'm perfectly happy in academia right now.
Okay. It's great talking to you, Raghu, but I'm afraid we've run out of time completely. So I'll have to end this conversation. Thank you so much for taking time out to share your view with our viewers. But last but not the least, here's wishing you and your family and all our viewers a very happy Bihu, Lori, Makar Sankranti and Pongal and a wonderful 2021 from all of us at ET Now. Thank you so much, Raghu.
Thank you.